As Narendra Modi sweeps more and more large Indian states, the country's political terrain looks set to achieve a degree of certainty and stability not seen since the 1970s. The markets have saluted this tectonic shift by vaulting to new all-time highs. But what really does an all-powerful Modi mean for the economy, for earnings and for markets? Today we have with us arguably one of the best equity strategists and long-time India watchers, Chris Wood of CLSA. His weekly Greed and Fear is essential reading for market watchers everywhere, and he has consistently been ranked Asia's top equity strategist by Asia Money. Chris, thank you very much for joining us on what's an important day for the markets. First, your assessment of the Narendra Modi impact on the economy itself, now that he has gotten stronger and probably more likely to return in 2019. What does this mean for the Indian economy?
Well, I haven't actually seen the Indian stock market reaction today, but I'm assuming it's a positive one. Clearly, the victory in UP was of a far greater dimension than people were expecting. So investors will now conclude that Mr. Modi looks highly likely to win in 2019, and that will increase expectations that he can continue to implement his agenda, which I think is basically both promoting development and what I would call digitalization. It's also, though, I think just from a political perspective, an incredible story that Prime Minister Modi took this massive risk of implementing demonetization policy only a few months before India's most important state election. And clearly that high-risk strategy has now paid off dramatically. I can't actually think of another incident where a mainstream politician has adopted such a high-stakes strategy and seen such incredible electoral dividends from that strategy in such a short space of time.
Okay, well, Chris, that's exactly the point. The markets, incidentally, have celebrated the Nifty touched 9119, which is the prevailing all-time high. So a new high was set today. But the point is, with this strengthening of Mr. Modi, even after this demonetization gambit, how might his policy change? Would you see him becoming, a little more pro-poor and therefore a little less earnings-friendly? Generally, what would be the impact on the economy and on policy making?
No, I don't think Prime Minister Modi his focus is clearly not on the stock market. His focus is on the development agenda. It's on promoting digitalization to accelerate the take-up of banking accounts, etc. But in my view, that's both pro-earnings and pro-poor. Obviously, there's one very successful policy from the previous government in India, namely the UID card scheme, which Prime Minister Modi had the good sense to keep up with that policy. And I think we're now beginning to see the early dividends from this incredible ID card, the fact that so many, that most adult Indians now have digital identity. This is a very unique story to India in terms of the global emerging market context. I think demonetization will serve as a catalyst to promote the use of financial assets in the Indian economy. I think it will also serve as a catalyst to move economic activity from the unorganized to the organized sector. And I think the combination of the electronic ID cards and the arrival of the smartphone in India, which will obviously have exploding take-up rates, makes the whole feasibility of promoting banking, digital banking in more remote areas more feasible. So India, because of the domestic demand story, is by a long way, in my view, the most exciting emerging market equity story in the global context because of all these factors. So the only problem for me is I can't raise my weightings in India as a result of this unexpected victory in UP because I'm already so overweight India.
That actually was my last question, because next question, because you've been arguing for India and China as your top two markets with 53% weight compared to a benchmark of 33%. But between India and China now, which market do you think offers better risk reward right now at current levels?
In the short term, China is way cheaper than India, so there's been a trade going on in China, and it can definitely outperform India in the short term. But in the long term, I'm very much structurally overweight India. I have more than 50% of my long-only Asia ex-Japan portfolio, which is like 25 stocks in Asia linked to macro themes in India, but I'm very much focused on the domestic demand story in India. Right now, we began the year with many foreign investors looking for reasons to sell India. In meetings in UK and Europe at the start of the year, I got a lot of pushback on the positive Indian view. People didn't want to listen to it. But I would say in investor meetings in Singapore 2 weeks ago, foreigners had started to capitulate because the Indian market has been much stronger than they were expecting. And I think this election result out of UP will further accelerate that capitulation by foreign investors. Meanwhile, the key story in terms of flow of funds in Indian equities in the recent past has been the ongoing inflows into domestic equity mutual funds. So this market is being driven much more by domestic investors, not by foreigners, and that's a fundamentally healthy development.
You know, which is a good point, Chris. But at the same time, is there a risk of, especially in these domestic stories, a bit of a bubble creation with too much money chasing too few stocks? I mean, you know, stocks like Maruti, banks, they have been some of your favorites as well. But these stocks have done well and are not inexpensive.
No, the critique of the Indian equity market for years has been that it's too expensive, and the best regarded growth stocks have always been the most expensive. And clearly there can be profit taking in these sort of stocks at any time. But the lesson of the Indian stock market over the last 10, 15 years is that it pays off to buy quality, to buy expensive stocks. And it does not pay off to buy value cheap stocks, because in the best cases, the value stocks end up as value traps. The worst case, the value stocks end up as something much worse. In terms of many of the most highly rated stocks, they're in the private sector financial services area. And on that point, my one criticism of the Modi government since it's taken over has been the lack of progress in recapitalizing the state-owned banks. Clearly, we have an overhang of a significant amount of stressed assets in the Indian banking sector. Most of those stressed assets are in the state-owned banks. That overhang is delaying the commencement of a new investment cycle in India. That's a macro negative. It seems to me that the Modi government has decided they don't want to proactively recap these banks. One, because it's too expensive. Two, because the government doesn't want to reduce the stake of the central government below 50%. So if we're not going to get the proactive recap, these state-owned banks will continue to suffer ongoing attrition. And the strategy seems to be now to allow the opportunity for the private sector banks to increase their market share at the expense of the public sector banks. And the exciting point there is that this represents a huge growth opportunity for the private sector banks. And their ability to grow market share has now risen dramatically, if not exponentially, precisely because of the arrival of the practical ability now to implement digital banking. So to me, these growth prospects justify the high valuations. So I'm not, while you can trade around technical levels, I'm just remaining structurally overweight this area.
Okay. Fair point. In fact, your big, your 10% of your holding is in HDFC Bank and IndusInd Bank. HDFC as well forms about 4% of your portfolio. Well, Chris, you may not want to move away from these stocks, but would you buy more of them at current valuations?
Well, it all depends how you're... I'm not going to add to positions today. No, that's the question. But if I really can't discuss individual stocks. But in terms of sectors, if you said to me what the core sectors to own in India on this financial asset digitalization theme, I would say private sector banks, insurance companies, housing finance companies, and broader financial service players involved with the world of mutual funds, consumer finance, etc. That's the area you want to be, that's the core area you want to own. In terms of long-term plays, I think there's a very interesting long-term story, but I emphasize the word long-term, in the real estate sector, because demonetization, the attack on black money, this very dramatic reform of the real estate market, where I believe you're about to see implementation of a rule where if a developer is doing an apartment development, they have to put 90% of the pre-sale cash flows into escrow. These sort of policies will result in a dramatic consolidation amongst real estate developers. There'll be probably a bloodbath, and that means there'll be a tremendous long-term investment opportunity buying the best Indian property developers with the solid balance sheets and a track record of completing the developments.
Okay. Well,
but that's a long-term story. It's not a short-term one.
Well, Chris, hold on to that thought. We need to take a break, but we are back with a lot more global questions to Chris Wood. After all, the Fed is meeting and a rate hike is possible. All those questions in a minute.